to go over the last 4 journal entries, and these are actually adjusting entries because they're December 31st. They will either impact a revenue or an expense account because we want to fully measure revenues for full 365 days. And likewise, expenses, we want a full 365 days of expenses recorded. So to get that, we have to adjust revenues and expenses to get a full measurement of 1 year, not a partial year. So we'll start with the first one. We adjust our records to recognize the services provided for the contract of July 1. So if we go back to July 1, cash was received for services to be provided over the next year. And then if we do July, August, September, October, November, December, 6 months have gone by, we've been providing those services. So let's go look. I went ahead and set this up. This is our first AJE adjusting journal entry. The original entry, right, cash came in and we recorded it as unearned revenue. Let's see, right here. We said cash was received, we owed services, which was a liability. So we debited cash and credited unearned revenue. So that was the original journal entry. Now 6 months have gone by and we've provided 6 months of that. So really 6 months at 12/31, there should be 6 months left, right, that we have to provide. So to get it there, we want to reduce unearned revenue of $12,000, right? Here's our adjusting journal entry. This account needs to go down because we've provided services, and this account needs to go up. So here's our journal entry: debit unearned revenue, credit service revenue. That's going to be our journal entry. If you want, we could see it this way. Unearned revenue, that needs to go down 12,000, right? When we're done, 24 minus 12, we'll have a remaining balance of 12. And then we've provided services, so that's revenue. And then we can assign our debit and credit. This side goes down with debits, it goes up with credits. So if I go back to my journal entries, I'm going to see the debit to unearned revenue, the credit to service revenue. And that's our first adjusting journal entry. The next one is to record 3,600 of accrued expense salaries. Accrued means we haven't recorded them. We need to, they happen, the employees have worked, and we need to accrue that added in as salaries for December 31st. So I could, this one, I mean, it is an adjusting journal entry, but it's easy enough just to figure it out with this, because what we're receiving, right, are the employees worked, but we haven't paid them. So employees worked, that's going to be salary expense. The employees worked, making salary expense. Last time we had a transaction for a salary expense, we paid cash. This time we're not paying cash, we will owe it. So we'll have a payable. In the future, we will pay money. So we will owe money. So again, this is an expense. This is a liability. And the liability is going up. So go back to our horizontal model. We have a $3,600 of salary expense. And we haven't paid that. So here's our salaries payable, $3,600 going up. And nothing happens on the other side. It's an in and out. And then once I have it here, it's easy. This side goes down with debits, and it goes up with credits. So I'm going to debit salary expense and credit salaries payable. And here's what the journal entry will look like. debit and credit. Okay, then we're going to record the rent expense for the year, and we had paid in advance for 2 years, $2,400 cash. Well, actually, that's $24,000 cash. So the original entry put $24,000 into the prepaid rent account. We can go back and take a peek at that. Right, cash went down. We put $24,000 into this prepaid rent account, and it was a debit, so it has a debit balance. So that's what the account looks like right now. But at the end of the year, and again, that was for 2 years. So really, 11 months have gone by, and so the ending balance of this account should represent 1 year and 1 month, or 13 months. And we will have used 11 months, right? There's 24 months, 13 are left. So we have used 11 months. So we can figure out $24,000, and we've consumed 11 out of 24 months. And let's see, that's $11,000. Yeah, so $1,000 a month, isn't it? So our adjusting journal entry will be to take $12,000 out of prepaid rent. We've used it, so that's going to become an expense, right? We've used the asset. Now I'm moving it over, that cost over to be an expense. So 13 months are left. We consumed 11 months. All right, there's my, well, that is going to be my debit and credit. Let's go back over here and put it in our horizontal model. So we wanted prepaid rent is going to go down 11,000. Again, 24 minus 11 will give us an ending balance of 13. And we have an $11,000 expense that caused retained earnings to go down. And then we saw the debit and credit earlier in those T accounts, but I'll go ahead and assign them here as well. Okay, there's our debit and credit. We can go and easily see that here as well. Okay, then the last one is supplies. They physically counted supplies on hand, $280. And let's remind ourselves, on April 10th, they bought $3,200 of supplies, and then they're going to count them, and there's only $280 on hand. Well, what happened to the difference? Well, they used it, right? And if you use something, that's an expense. Okay, so the beginning balance of supplies is 0. And this account, it does make a difference whether we have a beginning balance or not. So in this case, there was no beginning supplies because the company started this year. But if they'd been in the 2nd, 3rd, 10th, 20th year, there would have been a beginning balance. And then during the year, on April 10th, they bought $3,200 supplies. Well, what will happen is somebody's going to go to the supply closet and count them. So we're going to end up with a physical count of $280. So really what you're going to do is try to figure out, well, the account goes up and down. There's a debit credit rules for an asset. How much did the account go down? So we're really looking at a beginning balance of 0, and then we purchased $3,200. So there was a total of $3,200 of supplies available. And I'm kind of going through this longer process because with supplies, it's different than prepaid rent or insurance and that sort of thing. So there's $3,200 available to be used. If it had been a beginning balance, $600, and we bought $3,200, we would have $3,800 available. And then, you know, if we count 280 and that's what's on hand at the end of the year, then the difference 3,200 minus 280, I think that's 2,920. That's the amount that we used. And I would do the same thing over here in this one. What if we had a beginning balance? I'd do the 280 is what we ended up with, and then whatever that difference is, I don't know what it is, but that would be what we actually used. Okay, so this is what we're really dealing with in this illustration, though. So 2,920 is what we consume, so I want to take it out of the asset and move it over to the expense. When I set it up in T-Kent House like this, then the debit and right, the debit's always on the left, credit's always on the right. Remember Washington, D.C., debit left, credit right. Corny, but it works. Help you remember it. So we're going to debit supplies expense and credit supplies. Okay, let's go back to a horizontal model. And we want to reduce supplies 2,920. And then expenses reduce retained earnings 2,920 for supplies expense. Okay, and then again, this side goes down with credits, the other side goes down with debits, and then we can go back and look at that final adjusting journal entry, supplies expense, and then supplies.